Hello, everyone. Thank you very much for joining us for this presentation. My name is Brad Renard, and I'm with Upside Options, and I'm the host of this event for today. So thank you again for joining us, and this is the Investor and Trader Summit. If you have any problems, just go ahead and send a note through the questions panel. And if someone doesn't mind, maybe just send a little quick note and tell me if you can hear me just fine. Just want to make sure the audio is good. You should see a screen right now showing the agenda. And the first person that's going to speak today is Bob Lang. He's with Explosive Options, and he's going to talk about the power of the put option and how to create directional trades and portfolio and hedges in portfolios. So that will be the first presentation. The next presentation is at 11 o'clock a.m. East Coast time, and that's with Anka Metcalf. She's with Trade Out Loud. And she'll talk about top entry and exit rules for swing trading, stocks, and an intro on how to do the same with trading futures. Then the next person is Brad Renard. That's me, the speaker. And I'm at 12 o'clock East Coast time. I will talk about how to generate monthly income using credit spreads and iron condors. Then we have 1 o'clock, and we have Dan Ushman with TrendSpider. So he's going to talk about how the future of stock chart analysis, how technology, AI, and cloud-based systems can reduce workload and generate more winning trades. And then at 2 o'clock East Coast time, Barry Burns with Top Dog Trading, he's going to talk about how to interpret and trade pure price action. And then I'll wrap things up with a presentation at 3 o'clock East Coast time, and I'll talk about a sector rotation methodology. Okay, so if you ever have any questions, please go ahead and type them into the pane, little questions pane, and we'll be monitoring that. And I'm going to pass control over to Bob Lang right now so he can give the first presentation. Okay, Bob, you are on. Let me know if everything looks good on your side.
Sounds great, Brad. Thank you very much. I appreciate you getting us going this morning in this Investor Summit. It's great. So can you hear me okay?
Yes, you sound fine.
Fantastic. Okay. All right, guys, let's get going here. I'm excited to be with you and to share some of my knowledge about options with you this morning. And I'm also thrilled and excited to be with a couple of really good people presenting today with along Anka, along with Barry and Brad, and my good friend Dan Ushman, who is going to just dazzle you all with his showing a product about my favorite charting software, which is TrendSpider.com. So I'm excited to be with all of you today. But as a lot of you know, market volatility is back. In fact, it probably never really went away. And one thing that I am often asked is, Bob, I really want to know how to make money in a down market, or when the market is going down, or in a bear trend, or whatever. And one of the best ways to do this is to be able to play both sides of the market either simultaneously, or just to have a commitment just to the downside. It's hard to do that because markets move fast. They move painfully strong to the downside. And oftentimes when you're ready to get on board a downside move, it's probably already over. So this morning we're going to talk about this presentation called the power of the put. And I think a lot of people really are afraid to use options, and those who are afraid to use options really are afraid to use puts because they're afraid that they're going to get caught up in the swell of a big upswing in the markets, and it's going to render those puts useless. But as we know in life, insurance is something super important to have. And the insurance that we're talking about, like life insurance, health insurance, car insurance, fire insurance, we all have that stuff, right? We all hate to have to write that check at the end of the month. But if there's a disaster that happens, we're happy we have it. Well, insurance for portfolios is no different. So the put option acts as the insurance against your portfolio. I've lost more money today, this year, in long puts than I could care to admit. But it's just a cost of doing business because it protects the long side of my portfolio. We'll talk about some of those trades a little bit later on. So let's let's go ahead and get started in the presentation here. Again, I'm happy to have you all with me today. I'm fired up, and let's get rolling. So the power of the put. A little bit about me. My name is Bob Lang, again, and founder of Chief Options Strategist at ExplosiveOptions.net. I used to manage a portfolio of fund for Sunkist growers and the 401k way back in the late 90s, so it's kind of dating me a little bit, my age. I'm a contributor to TheStreet.com Real Money. Many of you probably know that I am a frequent contributor and have been for about 6 years for Jim Cramer's Mad Money Off the Charts. And with Jim, I helped coin, absolutely yes, you guys can Google it if you wish, helped coin the FANG term, the Facebook, Amazon, Netflix, and Google. I have a chat room regularly during the day. We'll talk about that a little bit later about what I do. But let's go ahead and get in and talk about puts. And I'll talk about this a little bit later since we're running a little bit short. So just real quickly before we get started here, I want to give everybody a special offer. This is free. Not much in life is free these days, but this one absolutely is 100% free. If you text to 33777 and type in 30-day, you will be allowed to join into the 30-day challenge. It's 30 days worth of information about options. It's about trading. It's about technical analysis. A lot of things that I've accumulated over 8 years of my service. I have a ton of content, and my girls who manage my site for me have collated all of the stuff and put it together in a very, very nice 30-day challenge package. Soup to nuts, you'll be able to know about trading, options, up and down, different styles, technical analysis, and so forth, and psychology, trading, risk management. So that's your free gift to everybody who's in the webinar today. So why buy puts? Paying attention to how the market trends, because markets are always very cyclical. We're in bear markets, but they don't last very long, right? Bear markets on the whole over history have lasted anywhere from 12 to 18 months. That's not very long at all, and oftentimes they last much shorter than that. In the Great Recession, the bear market lasted for about 6 months, and prior to that, we had about an 18-month bear market in 2000, 2001, 2002. If we look back at charts, the longer-term trend is always up. Bottom left, upper right. Puts are very powerful instruments, I believe, and if you use them tactically, use them frequently, and not being afraid to buy puts. Being ready for anything. It means that you can, as I said earlier, I get a lot of questions from people saying that everybody wants to participate in the downside of a market. They figure that, you know what, this is the only way for me to have some balance in life. And I get it. But not everybody is prepared to make money when the market goes down. Was anybody prepared on May 5th when the tweet heard around the world came out and the markets took a nosedive starting May 6th and didn't stop until going down about 7%? Was it? Probably not. Markets were at or near all-time highs, and everybody was shoving their money all in to the markets. Was anybody prepared about 2 weeks ago when another tweet came out the day after the Fed meeting, when it looked like we had an all clear after the Fed cut interest rates 2 Wednesdays ago? Looked like we had an all clear. But then the markets went up and then they reversed around to the downside, closed 500 points lower on the Dow from the high, and continued to move down into last week. Not many were prepared for that. But if you had some puts, as we did, we bought those the following day, the following Friday, and I'll show you how we did that a little bit later as well too. You at least protected yourself from enormous losses on your long side. Bear markets are short, fast, they are steep, and they are extremely painful, and they're very, very hard to pull back from, all right? The analogy that kind of applies here is markets go up the escalator. Bull markets go up the escalator. Bear markets are like falling out the window. You can see how fast the analogy works. Protection against the downside. Again, all we're talking about here is buying some protection. And when volatility is low, it's relatively low now. It was a lot lower a few weeks ago when we were at the volatility levels of about 12 or 13. Protection is cheap. I've been harping about it for weeks and weeks. Have some protection just in case, because things in this market in 2019, in 2018, in the last couple of years, news and tweets and sort of stuff come out of left field, and markets react to that. We have algorithmic trading, which we haven't had, we really has come onto the scene in the last 7, 8, 10 years, and those things trigger off of headlines. It's just something that we have to deal with. And when we're playing with options, okay, options have a finite life. Options expire, unlike stocks. So if we're trading options and we have the momentum in our favor, then all of a sudden it turns, we're going to find the value of those options becoming less and less over the next short period of time. So in 2018, it was the bad year for the markets overall. The S&P 500 was down about 6%. We showed a positive of about 8.2%. We did have a rough day of rough month of it in December. We were down about 4%, but the markets were down about 8 or 10% overall. We did post a nice win versus the markets in over the year, and because the puts protected us all through that last fourth quarter. And puts helped us get started off on a good foot in 2019. You can see here was the performance through March. We were up 18% at the year to date, 11.7%. And again, the puts helped us in March, in parts of March, to get us to those gains. And I'll just share with you what we did this week. All right. And these are some calls that we helped push our performance this week to a strong 2.3% versus the markets were down 1%. We had some SPY calls, we had some diamond calls, and then you can see at the bottom there we hit a whopper winner on Match.com, which we had bought $5.30 and sold those at $15 on Wednesday after the earnings came out, 200% gainer. But earlier in the week, we had these. All right, and this is coming off of 300% gains from Friday's puts that we had rolled down. We rolled them down from Friday and banked these winners. So we're able to be nimble enough to play both sides of the market, and that is how you make money with puts. Okay, you don't necessarily have to be all in, just playing the put side. But we're going to talk about some strategies as well too to play in this very difficult, challenging market. This is where we're at now. I put this out this morning. I printed this out last night. We're up almost 26%. Great outperformance for our portfolio. The return on risk is enormous. It's probably close to 100%, but I'm not going to share that only because I'll share the whole total portfolio. What is return on risk? It's the amount of money that is actually put at risk in options. So we put about 30% of our portfolio, 34% of our portfolio at risk. The rest of it sits in cash, so about 65, 70%. And that gets a return of about 0. So that's a heavy weighted instrument against our portfolio, and it's a drag. But we're still managing to beat the indexes with the little bit of capital that we're using. So markets will surprise us to the upside and the downside. More to the downside though, and again, the examples that I gave you past couple of weeks are indications of that. We had a surprise with the tweet that came out a couple of weeks ago that said that the United States was going to implement 10% tariffs on $300 billion in goods. The markets didn't like that, and they showed their animosity towards that decision. Then a couple of days later, the Chinese didn't like that, and they went ahead and started, working their currency against that to make an adjustment. And the markets didn't appreciate that. So this last Monday, we saw the S&P 500 dropping nearly 3.5% at one point. The S&P 500. Anybody remember seeing minus 100 on the S&P 500. The Dow was down about 900 points at one spot. In those instances, put demand was rising. We saw volatility going up. But in most instances, when volatility is declining or coming down, people are selling volatility. They're selling puts, right? Put demand is very short-term in nature. But the cost of those puts is going to go up extremely high when there's a lot of uncertainty, when there's a lot of money being pulled out of the markets, and when you see bids pulling away from the market, right? But as I always say, it's okay to have some puts on with some frequency, right? Even if they go to zero, even if you lose money on those things. It's a hedge. It's a protection against your long portfolio. So there's an old saying, two old sayings here. When the VIX is low, it's time to go. And that means basically that markets are complacent. And, certainly we've had conditions where markets can rise, and they tend to rise when volatility is low because big institutional players don't like a lot of volatility, and they're willing to put more money at risk in risk assets when volatility is low. Put protection is cheap when the VIX is low because the market is not expecting big moves. So when you get these big substantial moves in volatility up and down, okay, that scares people. And when it scares people, it causes them to A, sell stuff, and B, reach for protection. And when they're reaching for protection, you see a rise in volatility, and the protection of put protection cost continues to go up. Recently, we saw that VIX hit 12%, and it ran up almost 45% in just one day. Last week, we saw the same sort of thing happen. We saw actually in about 4 days, we saw the VIX run from about 12% up to about 24%. That's a 100% move in volatility over about 4 sessions. That's huge. So the other side of it is when the VIX is high, it's time to buy. Well, sort of. You have to wait. What I generally like to do is wait until that exhaustion run is done to the upside. So what happened on Monday? We saw a big pop up towards 24, and we pulled back down off that high and closed about 21, 22. And then the next day, we had lower highs and lower highs in that VIX. And then we had some follow through on Wednesday and Thursday. And even though we were up a little bit yesterday in volatility, it wasn't a smashing number. But when the volatility started to drop, it seemed to be fine and okay to go ahead and start getting long and buying calls or getting along the market because volatility was starting to move in a way that, seemed like that move to the downside in markets, to the upside in volatility was done. Make sense? When the VIX is up over 20, when it was over 20 for the better part of December, it was a very, very difficult time to buy. Raise your hand if it was easy for you to get in there and start buying stuff in December. Not very many of you. I get it because every single day was down except for 2 before Christmas Eve. And of course, we had a big, huge rally the day after Christmas, and we continued on to the end of the year. But still, it's not easy to step in there when it feels like there's a lot of panic in the air. Most people fail in down markets, I believe, just because we don't believe it's happening. We hear positives that might be the turning point for a down move. And we're off sides, which means we're not prepared for the downside. When volatility was cheap just a couple of weeks ago, you could have bought at the money puts for just a fraction of the underlying, right? You could have bought some at the money. The S&P the SPDR was trading at about 300 or so. You could have bought the 300 to 301 puts for about $2, which in normal volatility times, they probably should have been worth about 350 to 4 for a week or 2 out. So volatility was cheap, and it was cheap for a reason because nobody was expecting the markets to move very, very much. But then we had that big move, and if you're holding those puts, at least you protected yourself. You made some money, sure, but all you were trying to do was protect your long portfolio. One of the reasons why people fail, though, they stay too long in these puts. So maybe some of these moves, these big exaggerated moves, don't last too long. This last one, I would say 4 days, right? From the Fed day, which was a Wednesday, we had a big volatility there. We went up and then back down on Thursday, big, huge down day on Friday, and then all the way through into last Monday. So the markets dropped about 5% in about 4 days. That is a huge move in such a short period of time, right? But those moves are fast. And again, they're probably done by the time you're going to get bearish. So maybe a lot of people started to feel like they're going to get bearish. So they figure that, we're going down to Chinatown on Monday. Well, no, that was really the wrong time to do it. You needed to have some puts on before. And I get it. I'm not trying to be a predictor of markets. I'm not trying to be a naysayer of the bulls here. It's all about being prepared. Okay. And sometimes you need a little bit of luck, right? If it's going to work out for you. What is the definition of luck? It's where preparation meets opportunity. So sometimes you need a little bit of luck if you're prepared for that opportunity and you get lucky. The other reason why most people fail in options is they wait until it's too late to make money on the downside. I'll tell you, I'll go back to 2008, 2009, about 10 years ago. It was one of my finest years ever because I recognized that the markets were in turmoil. I made some money on Lehman. I made some money. I didn't make a ton of money, but I made some really decent money on Merrill and AIG to the downside, and a few other names like Amazon and Tiffany's and a few other names that got drilled. Everything got slaughtered, but it wasn't prolonged. It happened for a couple of months. That was one of those 100-year floods. It's probably never going to happen. Hopefully, never going to happen in our lifetime. 2001, 2003. It was a much more prolonged, agonizing. Painful with rolling corrections. It was like Chinese water torture. It was tough. Every time you tried to get in the market, you got smacked down in that 18-month period. It was hard. Unlike this last bear, which was really super fast. So another reason, some more reasons why people fail in down markets. And again, this goes back to the premise of what I mentioned earlier today. A lot of people want to make money in a bear market or want to make money in a down market. And they just have to flip their psychology over. When you finally hit a gain, you stay too long. I see a lot of people doing this. They're staying way too long. It's like, if you go to a party and you run into somebody who doesn't have any deodorant on, right? And he stays for a long time at the party and he starts sweating. Oh, you want to walk away from him. You can't, if you stay, he's there too long, right? And because he smells so bad. So it's that sort of thing. If you stay too long with those puts, they start growing hair and they smell really, really bad. And then all of a sudden you get a day like Thursday and it renders that insurance, those puts, rather useless. Markets will gap down against you. We're not trying to hit home runs here with these things. What we're trying to do is hit singles and doubles, right? Nothing wrong with hitting singles and doubles, right? Everybody knows that, right? So singles and doubles eventually do add up to home runs. Don't trade on revenge. A lot of people say they get angry because they feel that the market owes them because they had a loss they shouldn't have had. Raise your hand if you've been there. I've been there before. A lot of people have been there. But the fact of the matter is that every trade is an individual event. All right? We don't revenge trade. That's a psychological defect that traders have, and they feel I've got to get back at Apple because I lost money with it, so I'm going to use Amazon to get back at Apple. Think about how irrational that sounds. I know you're probably joking, you're laughing right now, but it's true. A lot of people think that way. Don't do that. So are you ready for the next market phase? Well, I've always said that guessing market tops or bottoms is a fool's game. Who cares about tops or bottoms? I just care about the trend. Give me the momentum and the trend, the direction, whether it's up or down, I really don't care, and I can make an option trade and make it work. There have been so many top callers in the past years, and they've been so wrong, right? Instead of calling the top, let's try and find stuff that we can make money with. Hedge fund managers, pundits, media experts, all give an opinion, but you really cannot make money on their opinion consistently. The best thing you can do, identify the trend, put all the evidence and the probabilities in your favor and write it out. So was December a correction or something else? We've been in corrections. I think we're still in a correction until we get a follow-through month in August from July on the MACD chart. This is what I look at for the long-term trend. We're still kind of in a bear phase. We're on the edge of getting out of it, which means we could actually move up higher towards the end of the year through 3,000 on the S&P and even higher than that. All indications are that it still might be a bull phase, but in the late stage of it. We've had some corrections. They've been very, very sharp and painful and swift. In December, more than 50% of the stocks were down 20% or more. That's enormous. That's an enormous amount of weakness in the markets. The leadership slipped. Some of the best names that we thought were leading the markets all of a sudden became useless. So what are the signposts? Some generous amounts of time spending below the 250-day moving average means that we have, it's difficult for us to get long these stocks until we see them stopping going down. Heavy turnover on the downside, on the down sessions, which we saw quite a bit in December. Rising interest rates, which we saw rates go up. A lot of people say that Chair Powell erred in December by raising interest rates another fourth time in 2018. They took that back a couple weeks ago, but hopefully it wasn't too late. We've had weaker data from overseas. The tariffs, of course, and trade issues create more opportunities, and we've seen some failed leadership from some of the best names out there. The clues are there. But what are you doing about it? You should be buying some protection. What happened in January? Well, we had volatility decline sharply from a vicious end to 2018. We've had spikes down in price action, but it had been brewing for some time. And here's a chart of what happened in January. We saw that the markets in January really took off, but in March headed up to those old highs from back in late 2018 and stalled and had trouble getting through there. I would tell you this: don't fear a correction. Bull and bear market cycles are normal, and you can make money in a bear market. Absolutely. Just be open-minded, be willing to say you're wrong, be willing to put a little bit of money towards downside trades, and don't be afraid to lose that money. Don't listen to the pundits and experts who will always tell you the wrong stuff, the things that are selling their book, which means their book of business is always generally long. So you'll even hear during days like Monday, and we had markets in turmoil on Monday, this is the greatest buying opportunity. We heard that in 2008. I heard that over and over and over again. It's a great buying opportunity. Meanwhile, markets just kept going down, 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 down. It wasn't about protecting your capital. It was about throwing money against the wall to see if it would stick. All right, that's not the right approach. I would like to look for confirmation. I prefer to look for confirmed moves, just riding up the trend. Bear market rallies. Okay, we've had some enormous bear market rallies since September of last year. That's kind of when we kind of went into our bear market phase. Again, we could be heading out of it if we get confirmation on an up month in August. But some of the biggest, most powerful rallies you'll find are in bear markets, just like you'll see some of the most spectacular bearish moves down in bull markets. Just the opposite, right? Confirmed trends, though, give us far better odds of making money than just looking for tops and bottoms. So go back to that chart again. Here's confirmation of up and down, right? So confirmation comes when we follow through. So if you look at the right-hand side of the chart, you see when I circled that we had a topping pattern over there, and we followed through a couple of days later, and we ended up coming down quite a bit after that. Elevated volatility, what does it tell us? It tells us that we can find clues when volatility is elevated. Option prices are becoming much more expensive. The protection is no longer cheap, which we saw last week when volatility rose up to 24. People were still coming after volatility. were still trying to buy puts on Monday, even as volatility was rising. Now, of course, if you'd have bought into it when the market opened, you still made money because towards the end of the day, but it was short-lived, right? Because we had that huge rally on Tuesday. So if you stayed around too long, remember the story about the guy with with no deodorant in the room. If you stayed around too long, you got burned on Tuesday. Protection is no longer cheap. You can take advantage of it and add some puts and insurance when volatility is down. It's subdued. Right now, we're not in that subdued phase. We're kind of in a transitional phase of volatility right now, right? We had a big spike up in volatility for about 5 or 6 days, and we pulled down a little bit, but we're in some violent moves. Look what happened yesterday. We started down, and we ended up down at one point 40 handles in the S&P 500, and we rallied all the way back and almost completely went positive, and then it was the last 30, 35 minutes, the markets got drilled. That is a result of elevated volatility. We'll see higher volatility in bear market trends, okay? When it tells us that option prices are elevated, calls and puts. It's expensive to buy, right? What we want to do is with volatility, we want to play for the bigger moves, but lower your expectations. So in other words, let's say you buy call options and you say, I'm in it to make 50, 70, 80% gains, which is great, fantastic. Maybe in puts, you say to yourself, you know what? 20 to 30% gains would be excellent for me. And you take those as you move along, and as we see sharp moves in a very short period of time, you're going to be okay. But truthfully, I would say most traders, bulls and bears, lose money in bear markets. And why is that? It's because the bears get faked out by the big spectacular moves up, the bear market rallies, and the bulls lose out because their hope is that the bear market is ending, and every single time they start buying, it's another leg down. Instead of waiting for the markets to stop dropping, they go ahead and jump in there with both feet, and they end up getting burned. I would tell you, don't fear a bear market. They're short-lived, and they often present some of the best and biggest opportunities you will ever get. So what is the reason to buy puts? Are you trying to make big money on the downside? I would say don't stay too long with these trades. If you are, lower your expectations, as we talked about before. Trade faster, trade smarter, trade a little bit more differently than you normally would. Bear markets mean you got to be on your toes. Don't be complacent. That complacency is being burned off when volatility was low, and when volatility is starting to rise, there's no more room to be complacent. So here's a chart of the Russell 2000 back in July 2018. It looked like it was about ready to roll over, and it certainly did. Dow Industrials peaked about 27,000 or something like that at the end of July in the last month or so. It corrected sharply. We're about 1,000 points lower now than we were back then. And this is why I think we're still in a bear market. This is a monthly chart of the S&P 500, but focus in on the MACD, which is the pane right below the volume bars. And what it shows is this is that until we cross over, which we did cross over, and once we get a confirmation, we did cross over at the end of July, the black line, thick line crossed above the red line. Unless we get a confirmation month, which would be August, which all we need is an up month in August, which we're a little far away from it right now, then we're still in a bear trend, still in a bear market trend here. It could change. We got 3 more weeks to go until the end of the month. Exactly three weeks to go, 15 more trading days. So we'll see how it goes. But is this the same market as we were, say, a year ago? I'd say no. Again, you see that MACD over there in that it's positive, and we saw huge move up in the S&P 500, higher highs and higher lows, and we pulled back off those highs. We're well above that right now. How do we manage around sentiment? There's a lot of different sentiment readings that I like to use. I'll just touch upon this one right here, fear and greed. Back in 2008, 18, November 4th, we saw a very, very low reading on the Fear and Greed Index, which is a composite of about 7 different indicators, including volatility, high yield, put-call ratio, and a few others. Very, very low reading. So all the way to the left, generally speaking, if you're a contrarian, like I am, you want to be buying things when they're that low. How about on yesterday? We're now extreme fear, right? You want to be buying this market based on this indicator. Again, it's just one indicator. I don't necessarily want to be relying on the one, but if the evidence of a whole bunch of other indicators are lining up with this one, well, it increases my odds of success. So what do? You hold on to lots of cash. You protect your long positions. You keep some index puts because they're still rather cheap, even with the volatility index up around 16% right now. You wait for your fat pitch to come in. You don't have to swing at every single pitch that's coming by, baseball analogy. You play that downside, but have a much lower expectations and be willing to play both sides of the market all the time. Change your tactics. Here are some notable changes that we've seen. The Fed did cut rates a couple of weeks ago. And they did say that we're going to wait and see some more data. Data has been sort of mixed over the past several days. We do have a Jackson Hole meeting coming up. The Kansas City Fed is hosting Jackson Hole, and Chair Powell is going to be talking there. I wrote a little bit about it last week, and I have some notes coming out next week on it. I think this is a moment where the Fed and Chair Powell is going to clarify a little bit better the message that he didn't send properly after the last Fed meeting, which is at the end of June. So look for that to change. And then we'll have another Fed meeting in September. Suspect that the market is hoping is looking for another rate cut, possibly 2. But some statistics, sentiment statistics here, that the put-call ratio stats have been quite high, and they've been rising. They've been very persistent, rising as of late. People have been buying more protection when the put-call ratios are starting to increase. We've seen an increase in bearish funds, as according to the RIDEX ratio. We've seen an increase in short interest. People are shorting stocks much more these days than they were earlier in the year. That long end of the curve, it's been nagging us. It's been endlessly talked about in the media about how the long end of the curve is inverted versus the short end of the curve. That's not necessarily a bad thing, but if it persists for much longer, it's going to create problems, and it's going to foresee the economy hitting some speed bumps along the way. Spreads on yield continue to narrow. We see yields on bonds from overseas going negative, perhaps, and we've seen that the Fed has been pressured into being much more active and possibly cutting rates even further. I don't think they're going to yield to that pressure. They shouldn't. Just pay attention to the data and pay attention to what they've been doing all along. But you never know. And then tariffs I think are much more of a psychological tool, as we've seen over the past couple of weeks. Every time we've seen some tariff talk coming out, tweets or whatever, it has a negligible effect, or has a much bigger effect on the markets than we would possibly have expected. So I'm going to touch upon a few things with explosive options here. I'm going to take a few of your questions. This is a great opportunity for you to join our community here. This is a great place for us for you to learn about options, about trading, about the technical analysis. We have a couple of different products for you to share. And again, I gave you an opportunity earlier to join in if you're new, if you're even intermediate, to try the 30-day challenge. The explosive options, which I showed you, is up about 26% year to date, and that's through Friday. Beating the markets. We've been beating the markets for a great part of the year. We got off to a rough start in January, but we've made up a ton of ground. We have a chat room that's absolutely just stunning. It's incredible. It's a great room where I'm in every single day. We get trading ideas. We share ideas. And I will tell you that if you sign up for the service today, either service, the chat room or the EO, which is explosiveoptions.net, I have a book that I wrote that we put out about a summer ago in 2018. I'm extremely proud of it. Let me show you what that is. Know Your Options. Jim Cramer wrote a little comment in there for me. Mark Chaikin, my good friend Mark Chaikin, did the forward for that. And I will send you a free book, free autograph book, if you sign up, if you just sign up today. So going back to the slides over here, the Explosive Options Pro Room is an unbelievable place for live conversation. It's a great community of like-minded traders. We call it collective intelligence. I share with you the trade ideas that I'm doing. A lot of people have in the room been there for a long time. They've made some really good money in the room, and it's this ridiculously low price. It's the best group of individual traders you're going to find out there. We talk about risk management all the time, being in control. My favorite phrase is we're in the moving business, not the storage business. This is about moving money around. Period. End of story. Our job is to book profits. Period. Okay? You don't sit around and wait to get stomped over. We're not a deer in the headlights, right? We get some people, new people in the room. Oh, I've got a 40-50% gain. What do I do with it? I'm serious. It's stunning that people don't realize what they're in this game for. They figure, I have to hold this. This is my lottery ticket or something like that. That's not how it works. We're in there to make money consistently, hopefully every single day. Some days there are not going to be opportunities to make money. Yesterday was one of those. So got to keep moving on to the next day. We learn about different patterns, trade structures. I do some teaching in the room. We talked about some different trading structures last week, like doing calendar spreads. But we know this market is a fast trading environment, okay? It's for intermediate traders, slow traders, this is a great environment, great place for you to be, the chat room and so forth. So I'm actually going to extend even a better offer for all of you guys attending today, all right? If you buy 1 month of the Explosive Options, go to explosiveoptions.net or text to 345-345 and type in options. I'm going to give you a free month, $99. For 1 month, you get a free month. You have 2 months for $99. It's so it'd be roughly $49. This is really what the price of the options service was when I first got started with the business in 2011 with Explosive Options. So you're basically getting the original price. You try it out for 2 months. If you like it, great. If you don't like it, that's fine too. But I think this is a fantastic way for you to learn. You have that 30-day challenge. You can try that for free. Whether you sign up for the service or not, you still get to do the 30-day challenge. This is a free gift to all of you. And then, as I promised, I will even toss this in. If you sign up for that $99 offer and you get the free month, I will also send you a signed copy of the book. That's a $20 value that you'll get for free. So you basically try the service. You get the 30-day challenge to learn a whole bunch of things, watching webinars, reading articles, and so forth, and listening to other professionals. And you get the book. If you're not done in a whole month or so after the 30-day challenge and reading the book and having an experience in EO, you should be ready to go and really get yourself up that learning curve of options trading. You'll get there. It's just I have all the tools are right there for you to get up there. So. Any questions that you have? I'm happy. I'm done a little bit early over here. I could spend a little bit of time and taking some questions from you. Anybody? Brad, do you see any questions out there for me and at all? Maybe we could talk about options for a little bit.
Hey, Bob. Yes, you do have some questions.
Great. I have the questions box open. I don't see any yet. But if you have any, go ahead.
I can read a few. I have it open right now.
Thank you.
Do you sell options or buy options or both? Primarily for the puts you were talking about.
Right. So I know you're going to be talking about credit spreads in a little while, so I know you do. I know you do those with puts and calls. We do those as well too. We have another service that does that. But I think by and large in the EO service, it's just a long call and long put service that we buy options, and then I'll send an alert out there to tell people what we're buying, and then in a couple of days, couple of weeks, whatever, I'll send them out, tell you guys when we're selling. Like in the presentation, I showed a slide with a copy of an email I sent out earlier in the week that we had sold the Match.com and the puts and the calls.
Okay. Have another question here. Do you ever do spreads, bear put spreads for the bearish trades?
Yeah, you know what? Bear put spreads are great because they cut your risk down quite significantly. I like spreads, but generally with bear plays, again, remember these moves are we talked earlier in the presentation. These moves are swift and they move really, really fast, and the puts gain value really, really fast, which means the long put and the short put are gaining value quite significantly. The best way the best way for me to do bear put spreads is to leg into them. So in other words, let's say I'm buying into, and just to completely get my risk out of it and then stay with the trade. So let's say I'm buying a SPY 282 put, it's $3. And we get a big sharp move down, and all of a sudden that $3 is worth about $5.50. I will look to sell a put underneath there, maybe the 278 or maybe the 277 put for about $3. So I'm looking to get my cost right out of the way. So I can't lose money on that trade. The best I can do is, on a $5 spread, make $5, but I've already taken my cost out of it. So the worst I could do is just break even. So if the market moves back and runs back up in my face. So so I like bear call spreads. They cut your risk down, but legging into them is a better way to go because the bear market moves are so swift and severe that you won't gain a whole lot of money if you just put the bear call spread or bear put spread on.
Okay. Do you ever sell puts, sell naked puts on stocks?
So I'm not a big fan of selling naked puts unless I'm willing to take that stock in before at a lower price. So let's say I feel like I want to own some Apple stock, and I want to be able to get it at a lower price. I just don't want to wait for it to get there. So what I'll do is I may sell some naked puts with the notion that I'm willing to take that stock in if the price comes down through the short strike and I end up getting it put to me. Generally speaking, for me and my clients in the service, if we're selling puts, we're selling put spreads. If we're selling calls, we're selling call spreads. Also, never sell naked call spreads. That's I'm sure is a big no-no. Some people do it, but you know what? Brad, you've been in the business for a while. I'm sure you've seen people get blown up by selling naked calls, and then having them blow right through the short call, and boy, is that a painful experience. But listen, I get it. I know people have been successful doing it. It's just not anything I'm comfortable doing. But selling naked puts is a good way to leg into stocks.
Okay. I have a question from Ray.
Okay.
Can you explain what your criteria are for long puts? For example, what's the delta, expiration, etc.?
Great question. So Ray, I like when volatility is low, somewhat low, like it was a couple weeks ago. I'll buy at the money puts. There really is no need to buy out of the money puts. The probability is rather low unless you catch on to some surprise event. Let's face it, when the news came out about those tariffs being applied to the $300 billion, that was a surprise out of left field. And I knew it. We all knew it could happen, but we weren't sure of the timing of when it was going to occur. So when it did occur, volatility started to creep in and increase. So buying out of the money puts would have paid off, but in most cases it doesn't. So as far as delta is concerned, I like buying something that's about a 45 to 60 delta, which means that I look at delta in terms of probabilities, right? So I look in terms of if I see something that's got about a 50 delta, it's got about a 50% chance of getting to that strike by the expiration. As far as timing is concerned, I'll go maybe a week or 2 weeks out with puts. I don't need to go much further than that. Again, sharp moves are happening very, very quickly. It doesn't really mean that I have to go out 2 or 3 or 4 weeks, unless I feel that we're still in a very deep, strong bear market. We're going to correct significantly. But look at these corrections that we've had. Ray, we had a huge correction in December, but it was only 1 month. We had a huge correction in May, but it was only 1 month. So if you took long-term puts, you may have made some money for a little while, but more than likely you probably held, if you didn't roll them, you probably held those, and you probably got smacked around when the market started to turn around in January and in June.
Okay. I have a question from Sri. He said, could you please provide more information on your 30-day offer?
Hi, Sri. So the 30-day, well, okay, it's free. If you go, let me go back to that slide here. So 30-day offer, actually it's this 30-day challenge, is a free gift to you. So if you text 33777 and type in 30-day, you will get a link to sign up for the 30-day challenge. So this is 30 days worth of content and material that I put through over the years, and my girls have put together a soup to nuts type of an approach for you to learn about options trading, spreads, calendars, technical analysis, sentiment indicators, risk management, all these sort of things, all the tools that you need to be successful in trading options. And I think if you go through this whole 30-day challenge from day 1 to day 30, you'll be ready and prepared. You'll be ready to open up an account. If you're brand new, ready to open up an account with a broker, and then you throw in layer on top of it the EO service, sign up for that, you get a free extra month. You get 2 months instead of 1. And then you get my book, which goes a little bit further than the 30-day challenge. You'll be uber prepared for options trading.
And Sri, you actually have a space between the 30 and the day. So Sri was trying to type that in. So just put 30 and then DAY with no space, right, and that should work.
Thanks, Brad. Yeah, 30 DAY. There you go.
Okay, David has a question. He says, is the $99 per month service just a signal service, or does it have an education component?
Okay, great question. So it's an the EO service. I basically send you ideas, trade ideas, recommendations that I'm doing for my clients, and for maybe it might even show up in the chat room. You might even see it on Twitter. But these are the ideas, trade ideas. There really isn't an educational component other than you're learning about trading. You're in the ditch with me, and we're fighting our battle together. The educational component comes in with the book and with the 30-day challenge. Listen, I'll tell you, David, the thing about it is that when the trading day is on, we have 6.5 hours of trading. That's not a whole heck of a lot. I don't trade futures any longer. So I have 6.5 hours of trading, and we have to really focus in on finding trade ideas, banking our profits, and moving on, that sort of stuff. So I don't have a whole lot of time to explain why I'm doing things to a certain extent. But if those other things, the 30-day challenge and the book, kind of explain a little bit of the rationale from what I'm doing, you kind of get into my head a little bit about things. Plus, I have these regular webinars that, like Brad does on a regular basis, usually once a month, and talks about after the close on Thursdays, for instance. And we talk about different things about trading and about psychology, whatever the topic is that I'm thinking about at the time. So that's where your educational component comes in.
Okay, I have a question from John. What's the average hold time for your open put trades?
Hey,
I'm
John.
assuming we're talking about the directional hedge trades.
Directional hedge trades. So, it depends. I mean, sometimes we've had some longer than others. I would say, generally speaking, anywhere from 4 to 7 days at the most. Sometimes they're a little bit shorter. Like, for instance, we put some. I had some puts on Wednesday, Thursday. I put some puts on the Fed day. I wasn't feeling really comfortable. We bought those 301 puts, and then we had that big, huge surge down on Friday, and we took those off the table, and I rolled them down, and then we captured some of that Monday move to the downside. So it depends. The key of options trading, and Brad will probably tell you this, is being flexible and not necessarily being rigid. You have to be able to move with the markets, right? You can have yourself a goal of saying, oh, I'm going to be in that trade for 4 days, but what if you had 100% gain after 1 day? Well, you know what? I'm not going to stay with that trade for 4 days. I'm going to take my profits off the table right then and there. So, but I would say by and large, we said, what is my average trade? It could be anywhere from as short as 1 day, but probably no longer than 7 days on the puts.
Okay, I think we have time for one more question.
Okay.
And this one's from Bob, and he has a question about opening puts on different underlying indexes. For example, instead of just the SPY, do you ever use ETFs like the XLK or the Qs or the IWM for the small caps?
Yeah. So
questions about different vehicles for opening puts.
Yeah. So those are great. I tend to like using ETFs. I use the SPY, the Qs, the IWM, and the DIA, which are the S&P, the NASDAQ, the Russell, and the Diamonds, which is a proxy for the Dow Industrials. I did have a couple of index trades on, or ETF trades on, like the SMH when that chart breaks down. Again, everything is driven by the chart. Everything is driven by the technicals in the chart. And if I see something breaking down, even if it's an ETF, sure, we'll go ahead and get in there and add those. But by and large, the hedges that I use for puts are mostly the index, because I'm long a bunch of calls on some other things, individual issues, and those are being hedged off by some of those puts. That's why we managed to have a pretty decent week last week. We were up probably some 2.5% when the markets were down. Let me see here. Let me bring that back up here. The markets were down about 1% or something like that. Let me. Here we go. Okay, you can see this on this slide. We were up 2.54%. The markets were down 0.35. Okay, that was we had a rough day yesterday, but we were still up over 4% at the time, and it gave us some good outperformance for yesterday. The S&P is down 1.95%. We're up 2.33. So big outperformance.
Okay. Okay, we're to the end of this presentation. It's 8 o'clock, so we should wrap up. It looks like we have a few more people that had questions. So if you have any questions, you can email them to either support@upsideoptions.net, and I can direct them to the proper location. Or Bob, where could they send you questions directly to you?
Brad, they can send them to bob@explosiveoptions.net, and they can. I'd be more than happy to get back to them, and if it's a question that I can answer, happy to do it. And bob@explosiveoptions.net. And I appreciate you inviting me on this morning. It's been great. Had a lot of energy today, even though I woke up kind of early, in California like you. But this is great, and you did a great job, Brad, and I appreciate everybody listening and attending, and hopefully we'll see you down the road.
Okay, Bob, thank you very much. Once you pass control back over to me, and then we can move on to the next presenter.
Okay.